So we continue our conversation regarding risk and return by now defining what is risk. So, investment risk typically is basically deviation from expected value. So in finance, risk is defined as a deviation from expected value. So the greater the probability there is of a return that exceeds or that is lower than the level that we expect to receive, then the greater the risk. Okay, so think about this as volatility, right? That's what our risk measure would reflect, the volatility of an investment. So first of all, let me just show you historically, right? If you had to gather information and this was gathered since 1926 for the U.S. market, but that reflects all markets around the world. Basically, if you look at historical returns, and these will be, let's say, monthly returns, right? So the price change during a month. You'll notice that, look at the first column. You'll notice that the average return, okay, for all of these types of investments will vary, is different. Large company stocks, for example, would have provided you with an average return of around 11.8%. Remember, in finance, it's always per year, right? 11.8% per year. While smaller company stocks would have realized a return of 15.20% per year. Okay, let's not worry about inflation right now because this is not relevant for us, but just look at long-term government bonds and treasury bills, right? For the same issuer, long-term government bonds offered a return of 6.1%, much lower than stocks. Why? Because debt instruments by nature, because they have priority of payments, they're perceived as less risky than buying a stock. If you buy a stock, you're the owner of a company, but remember, as the owner of a company, you will receive the payments last. Who will get paid first? The employees will get paid first. The government, in the form of taxes, will get paid second. The bondholders will get paid third, and you will be last. That's what we are called stockholders. We're called residual claimants. Translating that to English, we receive the crumbs, after everybody else gets paid, right? Which sometimes those crumbs can be sizable, and you may have high returns. The point is that you get paid last. Therefore, the risk of bonds are perceived to be lower than, say, buying a stock because they have priority in payments. And that is reflected in the returns, right? So debt instruments only have to offer you a return of, if treasury bills, these are 1 year or less, okay, of maturity, 1 year or less of maturity. They have to offer us 3.6, historically, they have had to offer around an average of 3.6% return. While long-term government bonds, 6.1%. Why higher? Because remember, the maturity is longer, so the investors have to wait longer to get their money back. But stocks had to offer much higher returns because of the higher level of risk. So what I want you to just realize by looking at this table is that notice that there is a correlation between the returns being offered and the volatility. So look at large company stocks, right? The large company stocks offer a volatility of 20.2%, meaning that roughly, right, like 68% of the time, the actual return that you would expect, so the average was 11.8%, could have gone up and down by around 20%, with 68% of the time. Okay, that's what this is saying, the volatility, 20.2%. So you could have gotten either 32%, or on the one hand, going 11.8 plus 20%, or 11.8 minus 20%, you would have gotten a negative return of negative 8 or 9%. So think of this as volatility. Standard deviation is a measure of volatility, and that measure of volatility is correlated with the returns. The smaller company stocks, you would I think most of us will intuitively say, yeah, you expect them to be more volatile, right? Because they're smaller companies, less established, and that higher volatility also means that they have to offer a higher level of return or compensation. So notice that as volatilities increase, then returns that have to be offered in order to compensate for that volatility also increase. So risk, return. Again, this is just emphasizing that relationship. Here's what I want you to think about. If you invest in a portfolio is just a group of 2 or more assets. So if you invest in a stock and then you invest in gold or in oil, or you invest in 2 or 3 different stocks, or a stock and a bond, whatever that may be, if you combine 2 different assets, then you already have what's called a portfolio or a group of assets in which you have invested on. Okay, let's suppose that you're generating a portfolio of stocks. Okay, so you have 2 or more stocks and that you're investing your funds in. Now here's the interesting thing: when you think about portfolio risk, the risk of that portfolio of those investments measured as the standard deviation. Okay, and don't worry about the standard deviation. There's an Excel function that allows us to find that very easily. For now, just think about standard deviation as volatility. Remember, as uncertainty, right? As movement around the expected value, and think of it this way: the higher the volatility, right? Remember, the higher the risk. So suppose that you buy one stock. Okay, so the x-axis that you see here is just the number of stocks in your portfolio. Okay, that's the x-axis. The y-axis, the vertical axis, is the portfolio risk. So if you have an investment of only in one stock, suppose that stock is relatively risky, how much will you hold as your risk? Well, the risk will be around, say, 35%. Now, what happens as you buy more stocks in your portfolio, as you include more stocks, say 10 stocks in the portfolio? What starts happening to your portfolio risk, to the risk that you bear from holding those 10 stocks? In my case, let me make this easier to follow. Okay, your portfolio risk now becomes around 24%. So the 24% up and down the expected value, above or below the expected value. So what starts happening? You see that as we increase the number of stocks in your portfolio, what starts happening to the risk of that portfolio? It starts falling, right? You can see that. Well, it's supposed to be a straight line. Sorry about that. Okay. Well, you get the picture, right? So notice that the portfolio risk starts falling. So why is that? Well, what happens is that as you include more shares, more stocks in your portfolio, and they are from different industries and maybe even different geographic locations, what starts happening? When one stock is affected in a certain way by economic events, in a specific country, for example, even, what happens to the other shares? The other shares, because they're in different industries or even in different countries, they may not be affected by the same event. So what happens is that, if you had invested all your company, all your funds into technology companies, then something that would have hurt the technology industry would have made your portfolio fall considerably, right? Or vice versa as well. Something that very good would have made your portfolio rise. But the issue is this. The issue is that they will all be affected in the same way. So your portfolio risk actually has a higher potential volatility if you invest in assets that behave in the same way. While if you invest in assets that behave in different ways, then you are more protected, because when some are affected positively, the other ones are not as much, yes. But when the first are affected very negatively, then your other assets, because they don't have a high level of co-movement, correlation with the first assets, then they're not going to be affected as much. So your overall portfolio return, the risk that you're bearing, is going to be much lower, right? So the risk that you're going to bear from a portfolio that has assets that behave in different ways is going to be lower, because they kind of offset each other's risk. I hope that makes sense. Okay, so the more the number of shares that you have in your portfolio, then the more diverse your portfolio is, and that's why you're exposed to less volatility. Again, because their different assets with different industries and different geographic locations will not be affected in the same way. So the impact of a negative news is going to be much weaker than if all these companies will be in the same industry affected in the same way by a single impact. So what does this tell you as far as the lesson here? The lesson is, if you want to sleep well at night, then as long as you hold around between 10 and 20 shares in your portfolio, you would have reduced your portfolio risk by a considerable amount. Can you reduce it further? Can you go down further? This part. If you invest in 2,000 stocks, yeah, but look at the marginal benefit. The marginal benefit is very small. By the time you get to this point, you would have reduced a lot of all of this risk by just holding between, I don't know, say 15 stocks or 14 stocks. Okay, so you can go to 2,000, but the added benefit, the added amount that you would need to reduce all this portion, right, is really marginal. So you can diversify. That's diversification, means being able to reduce your risk by combining assets in the right way from different industries, different countries. You can diversify sufficiently when you hold around 15 different shares of stock. Okay, so what is really the risk that we care about as investors? If we all know that we can diversify and reduce our level of risk by combining stocks, 15 stocks or so, what are we all going to do? More than likely, as reasonable investors, we're all going to try and diversify. We're going to try and have 15 shares or more, right? So what is the level of risk that we actually worry about if we assume that we are all rational, diversified investors? If we all diversify sufficiently, right, all the dark blue part is going to be basically almost eliminated. So what is the only part, the only volatility that remains and that would not be removed even if we diversify and use 2,000 stocks? What is that risk? That level of risk is all this part, the lighter blue, right, area. This is called systematic risk. So think about systematic risk as the risk that you bear even if you are a diversified investor. Okay? And unsystematic risk or diversifiable risk is the risk that you can diversify away by choosing assets that are affected in different ways. So think of it this way, right? If you are an investor, the risk that you really care about, if you are a diversified investor, and we assume that we all are because we all want to be able to reduce this risk, then the only risk that you really care about is the systematic part. So when we talk about risk and return in finance, the risk that we're trying to measure is systematic risk because we are all assumed to be otherwise diversified investors.